The Complete Guide to Property Investment by Rob Dix. Property is a tried and tested approach to getting to financial independence. Every rental property purchase, if purchased well, should bring in money each month and also grow in value over time. However, property also comes with a high amount of risk and is an industry that seems to be full of charlatans who are out to make a quick buck. It is so important that you do your own research, educate yourself, and have a clear business plan or strategy that will get you to your goals. The 5 common real estate investing strategies covered in this book are as follows. Strategy 1. Save hard, take it easy, and retire well. Build a healthy income stream over 20 years without working too hard. Invest enough capital to buy one high-yielding property every 18 months. Then increase the pace as rental income compounds until it hits your desired level. Strategy 2. Recycle your cash. This strategy aims to build an income stream whilst limiting the amount of capital that needs to be invested. Find properties that need work doing to them. Buy them at a discount because there are less buyers in the market due to the work required, then refurbish the property. This will then allow you to get the property revalued by the lender and possibly refinance money out to use towards your next deposit. This strategy takes more skill and effort, but should allow you to get to your goals quicker than strategy 1. This is a very popular strategy, but you need to have an understanding of how to value the work that needs doing to the property and how much the property will be worth after the renovation is complete. Strategy 3. Lock away a lump sum and watch it grow. Invest a lump sum of cash and grow it over time. The example used in the book uses a sum of $250,000 to spread across 6 properties based in city centre capital growth orientated areas. This sounds like a lot of money, but often people have a windfall or equity in their own home that they want to invest. The focus here is to buy properties with an eye on capital growth in prime areas. Often capital growth can lead to huge returns over the long run. In strategy 1, the focus was on higher yielding properties with any capital growth as a bonus. In this strategy, the main focus is on capital growth with the resulting lower cash flow. In the future, you can either sell some of the properties and pay off the other mortgages, or sell them all and invest in something more passive like the stock market. Strategy 4. Replace your wage with rental income fast. Turn cash in the bank into an income stream that allows you to quit your job as quickly as possible. Do this by buying a small number of super high cash flowing HMOs. A HMO stands for House in Multiple Occupation and is where the property is rented out by the room to multiple people. Students or young professionals are typically the tenant profile for these types of properties, so the location is very important. This can generate a lot more cash flow, but typically comes with more effort, higher maintenance costs, and more void periods. Strategy 5. Flip your way out of the day job. Become a property trader by buying, renovating, and then selling properties for a profit. This strategy is for someone that is desperate to replace their income and leave their job as quickly as possible, but doesn't have enough capital to follow the HMO strategy. This is a risky strategy and is not really investing at all because you are just basically replacing your job with a full-time building job. There are so many strategies out there, and these are just outlining the most common strategies. The less capital you have and the quicker you want the results will generally mean that you need more skill and have to put in more effort and time as a result. Choosing your area to invest. First, you need to decide if you want to invest close to where you live or look for an area further away that has good potential. A good strategy is to network with successful investors and try to coattail the locations that they are investing in. Always look for fundamentals such as shops, schools, hospitals and good transport links, which will mean that there will be plenty of jobs and it is a desirable place to live. This should mean less void periods and more tenant and buyer demand, pushing up rents and prices. Any areas that are getting a lot of investment and infrastructure development can also lead to strong capital growth. It is important to know what your strategy and goals are before you start looking at areas, because certain types of strategies will often only work in suitable areas. Building a long-term portfolio and financing portfolio growth. Access to finance is normally the most common thing that is holding people back from growing their portfolio. The most common ways to raise finance to expand the portfolio are as follows. Number 1. Putting in more of your own cash. Number 2. Creating equity, such as refurbishing a property. Number 3. Waiting for the market to create equity for you. Number 4. Raising funds with a parallel strategy, such as deal sourcing or buy to sell. And number 5. Bringing in outside finance, usually done via joint ventures. Usually by providing a fixed percentage return on cash put in by a private investor or by pooling resources and co-owning the property for a long time frame. This is often marketed as a way for people with no money to get started in property, but I don't see why anyone with no money, no property experience or track record should be learning to invest in property whilst risking someone else's money. It seems to be a good way to sell courses though. Exit strategies. If you have built out a portfolio of properties, there will be a point in time where you want to start taking it easy and winding down to retire. Common exit strategies are as follows. Number 1. Hold forever, as you can still get loans based on the rental income, but not many people want to be worrying about interest rates in their old age. Number 2. Sell some of the properties to clear the mortgages on the remaining properties, leaving you with a debt-free, inflation-proof income from your portfolio. Prices creep up over time, and even on an interest-only mortgage, a large amount of equity will have been created, providing the portfolio hasn't been refinanced too aggressively. Number 3. Liquidate all the properties and then reinvest into another asset class, such as the stock market. The reality is that most people will use a number of these to get the right balance for them. For example, maybe sell a few of the worst performing or higher hassle properties to clear some of the debt, and then diversify into a global portfolio of stocks and bonds. If you are going to invest in property, you need to educate yourself and do a lot of research. The most important idea in this book for me is the triangle between capital, time frame and effort. The less you have of one, the more you will have to utilise of the others. For example, someone working 60 plus hours a week in London is going to struggle to buy, refurbish and self-manage a HMO in Liverpool. Everything in life has trade-offs, and this triangle is the key to having realistic expectations of what can be achieved in property, and more importantly, being able to spot the charlatans that are just trying to flog you a course. Property is full of people selling get-rich-quick strategies or courses to invest in property with no money down, but don't believe the hype. After all, it's called property investment for a reason, and that's because you need a decent amount of capital to invest.